Welcome back to Intelligent Investment Today, the podcast concerned with all things value investment. In each episode, we take a look at a different topic from the world of investment and attempt to apply the lessons as taught by value investment's founding father, Benjamin Graham, to the matter at hand. In this episode, we should be considering something that is very much in the news right now, and that is what could very well be the latest meme stock craze. This time it seems involving Krispy Kreme donuts and GoPro cameras. We will refresh ourselves once again on what we mean when we talk about meme stocks and how these manias that continue to crop up from time to time can push stock prices so far out of alignment with reality. Finally, we will consider what this means to the investor following the value approach and how they can possibly even profit from the market's follies. So without further ado, let's dive right on in. As ever, kick back, strap in and get ready to take on board another lesson in value investment as inspired by Benjamin Graham. So it seems we may be back here once again. Enough time has elapsed for the great body of investors to have forgotten all about the Gamestop saga, and the time it seems is right to begin a whole new epic. Regular listeners will be well aware that we've discussed what happened with GameStop back in 2021 on this podcast before. But for new listeners, here's a quick recap. In January 2021, the fact that GameStop had been heavily shorted began to do the rounds on the Reddit forums. Shorting a stock is a mechanism whereby investors who are convinced a share price will go down in the near future can make a profit from that falling stock price by borrowing the stock and then instantly selling it on. But of course, the very fact the stock has been borrowed means that ultimately they must return the stock to the lender. So if a stock is borrowed at $1 and then instantly sold, should the stock price subsequently fall to 75 cents, say, then the person shorting the stock can latterly return the stock to the lender and pay only the new lower rate to do so, netting in this instance a 25 cents per share profit. So this can work out great if the person shorting the stock is right in their prediction that the stock price will fall. But of course, if they're wrong and the stock price instead rises, then in order to return the share to the lender, as they are contractually obliged to do, they must now pay the new higher price. As in theory there is no limit to how high a stock price can rise, this means potential losses are infinite. So short sellers are exposed to the risk known as short squeezing. This is often where a sudden piece of good news becomes apparent, lifting the stock price. In order to limit their losses, those shorting the stock will be quickly forced into closing their short positions and returning the stock to the lender to prevent these losses from mounting further still. But this increased demand for the stock from these short sellers is likely to push up the share price further still, which will trigger even more short sellers needing to cover their positions, creating further demand for the stock, and then the whole thing starts to snowball, pushing the stock price well out of line with reality. In January 2021, around 140% of GameStop shares had been shorted, so convinced were the markets that the stock was overpriced, which of course must have meant that some shorted stock had been relent and shorted once again. Around this same time, members of a particular Reddit forum had been discussing the fact that GameStop seemed to be undervalued, and with so much of the stock being shorted, they could easily manufacture a short squeeze if enough of them started to buy the stock, which from their point of view would hopefully push up the price. On January the 27th, 2021, it was reported that this particular Reddit forum had received over 70 million page views in just 24 hours, breaking all-time records, with the community quickly surging to around 6 million users. Now, even if a small fraction of these members were to actively start purchasing GameStop shares, and even if these were relatively small positions, it is not hard to see why demand for the shares would skyrocket and push the price up higher and higher. And this, you will not be too surprised to hear, is exactly what did happen. The stock price increased by some 1,500% over the next 2 weeks, fueled simultaneously by the demand from Reddit members and from short sellers desperately trying to close their positions. The GameStop share price reached an all-time high of around $500, which was around 190 times the stock price from just some 9 months previous. But needless to say, what goes up must come down. A few days later, the stock dropped by around 80% in value, and by the 2nd of February, it had dropped below $100, knocking off some $27 billion in value. The share price of GameStop yo-yoed around for some time, with Reddit users unsure which way things were heading. Let's fast forward 4 years, and today they sit around the $23 mark. The reason we're here today talking about it once again is because Krispy Kreme and the camera maker GoPro have seen recent surges in their share prices, seemingly as a result of the popularity of these two businesses with users of the very same Reddit forum that was at the centre of the GameStop saga. It seems, as with GameStop, forum members are attracted to these businesses because both have been shorted by investors more generally. It must be said that neither have been shorted anywhere near the levels that GameStop had back in 2021, but forum members typically never like the facts to get in the way of a good investment opportunity. Of course, this is early days and interest may well fizzle out, but we have already seen some of the volatility in the stock prices of these two that would indicate purchase and sales based upon something other than the underlying attractiveness of the business. For those who espouse the merits and validity of the efficient markets theory, something we've talked about very recently on this podcast, then there could be no better example than meme stock crazes, why the idea that the markets are efficient is one for the birds. I'm not going to insult anybody's intelligence here by saying we should avoid these manias as value investors. I don't think we were ever likely to be participants in them. And if we were back then, the fact that you're here now demonstrably proves the lesson has been well and truly learned. A teenage version of me got burnt by the dot-com bubble, remember, so there's no judgment to be found here. Now to the point in the prelude. How can we as value investors potentially profit from such market follies? We've already alluded to the fact that whenever stock prices rise out of line with anything that can be considered real or factual, they must sooner or later come crashing back down to earth. And when they do, they rarely fall to levels that can be considered sensible or fair from the viewpoint of considered financial analysis. Normally they crash straight through that level and find themselves in the basement. Once a stock price becomes detached from all reality, then no price is either too high or too low to pay. This potentially gives the value investor the opportunity to sweep up these bargains when the market fully washes its hands of the whole thing and wants nothing more to do with the debacle. I cannot comment on whether GameStop has ever been a bargain subsequent to its prodigious rise back in 2021, simply because it's a stock that I've never analysed. But the potential for overcorrection seems manifest enough. It will be interesting to see how what the Financial Times are tentatively calling Gamestop 2.0 works out. Could we really see a repeat of the saga so soon? Did anybody learn their lesson? I'm really hoping things are too fresh in the memory for another fiasco like we saw back in 2021. But what is certain is that sooner or later a new generation will rock up and make all the same mistakes again. Because in investment, the more things change, the more they stay the same. And that is all for today's podcast. I do hope you've enjoyed reflecting once again on meme stock crazes. And whilst this is not something I expect any listener of this podcast to get caught out by, it remains an interesting realm in which we can consider investor psychology more generally and in contradistinction to how we as value investors like to act. To understand Mr. Market is to know Mr. Market, and only through this knowledge can we take advantage of him when the time is right. As always, do consider adding to playlist so that you'll be alerted as soon as any new additions land on your platform. And please do continue to spread the word. It really does make a difference. And that way we can make this as large a community of like-minded investors as is possible. I'm David Coombs. This has been Intelligent Investment Today. Until next time, stay safe and happy investing.